absolutely. And we'll talk more about that because, like you said, a lot of news from the auto space as well. So that entire pack doing well. In fact, some of the auto ancillary companies also doing well, right? Sona, BLW, of course, are news. But there's something like an SML, Isuzu, Atul Auto, all of these stocks doing very well from the smaller companies. In addition to autos, it is some of the metal names that are holding up really well. So a few of those will be up for you, and some of the PSUs. So some of the, the likes of ONGC, Power Grid, these ones are holding up as well. Of course, it is the banks and tech which is under pressure, and that is exerting a lot of pressure. But remember, we have a lot of cues to track. Fed Chair Powell will speak later today, so that is going to be extremely important from a market standpoint. You have a lot of macro data ahead in this week. India CPI and IFP data will come out. It will come out from the US, Japan, China, UK. So we're waiting by for a bunch of that data. And of course, you do have Brent prices to track. That will be all important. And then the tech earnings. This is a big week for tech earnings. So once TCS is done. So now we have the rest of the pack, which will also post their earnings later in the week. So that is what we're tracking in terms of cues. But let's start with TCS then. IT Bellwether kicked off the third quarter earnings season with a revenue beat. There was a mild miss on the margin front, but the stock has slipped after opening in the green. It is also off the opening, the lows that we saw today. But Rima, what really has the stock under pressure?
Well, one, there is still no clarity on future demand, FY24, FY25. Two, the deal wins have moderated on a sequential basis. $7.8 billion of new deal wins in Q3, which compares with $8.1 billion in the prior quarter. The headcount has come down. One of the reasons for the headcount to come down is because attrition is coming down. The company is already hired aggressively in the first 9 months of the year. But the other reason could be, and that's what the street is reading, is that the company is preparing for some sort of a slowdown. And remember, TCS's headcount has declined only thrice in the last 1 decade. So this is a fairly telling point. Apart from that, the management commentary is also indicating to rising caution in the European region, which contributes about 15% to their revenue. And just take a look at what the deal wins are, right? One would assume that deal wins today would translate into revenues tomorrow. Now, in FY22, the company had deal wins which went up by 10%. There was an increase in their deal wins by 10%. And this is translating into a double-digit growth this year. But in the first 9 months of FY23, the deal wins have gone up by only 3.5% on an aggregate basis, which perhaps gives you an indication that in the coming years, not necessarily FY24, but in the coming years, the revenue growth will be slower. Also, look at the street expectations. The street is penciling in that growth is going to slow down significantly. In FY23, Morgan, Kotak, they're all anticipating TCS's constant currency revenue growth to be about 13-14%. But next year, they expect that growth to come down to 7.7, 7.9% respectively. So the street is penciling in a significant slowdown. The stock is also currently trading at 25, 25.5 times forward multiple, which is higher than the historical average multiples that the stock used to enjoy pre-COVID, which was close to 21, 22 times. So these are a couple of reasons which could be weighing on the stock. Earlier today, we caught up with the management of TCS. Listen in to an excerpt from that conversation.
Our business is on a very focused customer set, both from a market perspective as well as from a client universe perspective. So the way I would look at it is, rather than try to parse the overall big global economy picture, if you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today, compared to 5 years ago or 10 years ago. So balance sheet repair has happened. The EC money actually resulted in a fairly good disciplined execution on that side. The financial markets, of course, react to the repricing of the asset on terms of where the interest rate is. But when we are looking at actual individual companies, they are more impacted by the supply chain issues, which have kind of played out through the year. They are in fact on the absolutely on the getting mended. Geopolitical issues in Europe will continue to have an impact, especially for that market and for some of the long supply chain kind of industries. But others in UK, in US, they are in a much more stable situation. So our own view is that there will be some impact of the overall negative commentary that is there in decision making. But when we take, let's say, a 6-month view or a 12-month view, we are much more positive, because we believe that our client universe, their underlying business is in good shape, and that is what is driving our positive outlook on our business compared to where the overall economic commentary is.
2.2% growth and an improvement in margins is not a small achievement given the circumstances. So what led to that, both these positives?
I think it's a very, very satisfying quarter, 13.6% year-on-year growth. I think we stayed very focused with customers, being part of them, working with them, put feet on the ground to see what matters to them in these tough times, right? Especially as they grapple with uncertainties in the macro side. What does it mean for them to stay ahead of the curve? Where is it that new technologies can help them bring efficiency, help them bring automation, and then at the same time work with them to define the future now, right? And I think that's what really is. In a nutshell, I think it's about cloud, right? Everybody moves everything to cloud, and
as you call the race to cloud.
Yeah, race to cloud, and then it's about you don't stop by moving to the cloud. You keep improving it, you keep bringing in automation. The beauty of these digital technologies is that a new technology comes in, a new way of working comes in every month, right? So short is the improvement possibilities, with the result that customers are always willing to adopt something new for bettering the growth, bettering the efficiency, and bringing innovation to differentiate themselves in the marketplace.
Okay, well, I have more on that, but before that, Milind, while it is a large number you hired in terms of freshers, the street is a little worried that your total headcount is actually a few thousands less. Okay. Is that preparing for likely fewer orders in this year?
So a couple of points I would make. One is basically if you look at year on year, we have grown by 57,000 people.
Yes.
So that's almost 10% growth on the number which we had last year. And we also hired a lot of people last year, and basically close to 200,000. Yeah. And then a lot of talent development over the last 3 quarters, and eventually they're getting deployed now, in this quarter, and thereby increasing the utilization a bit, and also efficiency in the organization is basically causing this headcount to come down. But actually, if you look at it, look at 2 years together, I think we'll be even.
Samir, I wanted to ask you about the margins. It's impressive that at a time like this, you are, not only delivered better margins than quarter ago, you're promising to exit at 25%. How are you so sure, and what led to that improvement?
Okay, fair. So I think this is still an aspiration, but we have put it out at the beginning of the year when we gave our full quarter increments, and we came in at 23.4. We said we want to exit this year at 25, and structurally we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. 2 specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year, and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
And there is still space over there?
There will be operational levers from an execution rigor perspective, which always will be there. Fees to external consultants still provides us an opportunity. There will always be puts and takes in terms of how it would set up. Second factor is currency has been beneficial to us, and that also we have been calling it out.
Okay, well, the market is still under quite a bit of pressure. So the Nifty is now down 135 points, and there is no sign of respite in the market, on the equity markets, that is. So let's do one thing. Let's take a quick break. When we come back, we will track the commodity space with Manisha Gupta. So don't go anywhere.